Welcome to everyone. I see that we have about 25 people joining us from around the world, I think. Good afternoon. Welcome to our webinar hosted by Altair and the AUHF. My name is Alison Changana. I'm with CAF, the Center for Affordable Housing Finance, which serves as the Secretariat to the African Union of Housing Finance. I'm actually joining you from California, so we're spread across the globe in our engagement today. What we have today is part of the Rent to Own webinar series that we've been holding over the last few weeks in partnership with Altair, the member of the AUHF. The focus of the webinar series is around the Rent to Own model and its role in supporting affordable housing and the mechanics, really, the practicalities and the intention and purposes and the uses and the role that rent to own can play in the sector. So in the first session, we really focused on the concept of rent to own and what makes it a success. So what are the preconditions for success for this particular model towards home ownership? The second session analyzed the different models of rent to own and broke those down in terms of their different components and how they operated. And that was quite a useful session. And building on that today, we're going to unpack the financing and the legalities of rent to own with some more specifics around particular case studies and an attention on the African continent and case studies from that region. Our final session in 2 weeks' time, we'll look at more case studies and unpack it in further detail. So in terms of who we have with us today, we're honored to have Altair working with us on this partnership and have been organizing this. We've got some real experts on rent to own. Neil Toner is a partnership at Devonshires. And we also have Derek Joseph, also with the chair of Aquila Services. And then Andrew Cowan, also a partner at Devonshires. And they will be taking us through the presentation today. So I wanted to ask you, just in terms of mechanics, if you could kindly introduce yourself in the chat. We can know who's with us in the room today and get a sense. And then in terms of questions, as we go through the presentation, you can go ahead and put those in the chat as well. And we will keep an eye on that and take some questions at the end of the presentation. So with that, what I'd like to do is just to hand over briefly to my colleague Thandiwe, who will just give a little bit of a word on the AUHF itself. Thanks, Thandiwe.
Apologies, I was on mute. Thank you so much, Alison, and good day to everyone. Thank you so much for joining us for the webinar today. So my name is Thandiwe Dlamini, and I am the coordinator of the Africa Union for Housing Finance, which was established as a member-based organization in 1994 June. Only starting with about 11 members then, but we have since grown. Today we have 58 members in 24 countries, and our members include commercial and mortgage banks. We also have building societies, microfinance banks, prop tech companies, housing development corporations, individuals who are really involved in housing finance and housing development across Africa. And we also have we also have membership within Pan-African organization and international NGOs as well. And the AUHF as an industry body, we really promote the development of effective housing finance markets and the delivery of affordable housing across Africa, working, of course, in the interest of both our members and the industry as a whole. And I also wish to invite you to one of our key engagements that we have each year. We have our 38th annual conference and AGM, which is coming up from the 28th to the 30th of November. And we are having it in Cairo, Egypt. So I wish to invite you all. Please visit our conference website, www.auhfconference.com, to see more details about the conference. We have our agendas, speakers, more information about travel and everything on the website. And also I wish to invite you to join the AUHF. Please visit the AUHF website, which is www.auhf.co.za. And please join the AUHF family. As the AUHF, we look into engagement, stakeholder engagement amongst everyone who's interested and cares about housing finance across Africa. And your contribution and you joining the whole family is greatly appreciated. Please feel free to be in touch, and we look forward to welcoming you at the AUHF. Thank you so much. I'll hand over back to Alison.
Great, thank you, Thandiwe. I think what we'll do is we've had 2 previous sessions, so what I want to do is jump right into the meat and potatoes of the session today, so to speak, and go ahead and hand over to Derek to take us through a little bit of a recap, and then we'll jump into the finances and the legalities. Thanks, Derek.
Thank you, Alison. Thank you, Alison. We haven't got much time, so I'm going to do a very, very brief recap. I'll give you the out-air advertising to say we're probably the largest independent affordable housing consultancy in the world. And after that, I'll say no more about it. What we're going to do in today's session is a brief recap of what was said in the previous 2 sessions, and to remind you that there is going to be a 4th session in a couple of weeks' time, which will actually go through some real schemes, whereas what we're going to do today is talk a little bit more about the legal structure and the financing structures of these schemes, but we're going to a very limited way. Some obvious points from the past sessions. There is a major shortfall in Africa of housing provision. Providing affordable housing benefits not only people, but the number of jobs and economic drivers that it provides. Rent to own, provided at scale, could address some of the major needs. And certainly in Europe, it has been one of the major drivers of providing housing to lower income households. There are lots of different models of rent to own. They're always designed to fit the legal and financial structures of a particular country and the particular political drivers that behind it. So what we're looking at are sort of the major principles. There aren't standard models. And rent to own is done by governments, it's done by private developers, it's done by NGOs. There's no reason why any part of the housing industry and sector can't do rent for own. It's about how the incomes of the households being addressed and the position in the in provision in terms of pricing. So rent to own can be branded in lots of different ways, sometimes shared equity, sometimes flexible tenure, but they're all forms of rent to own. What is rent to own? I mean, Andrew and Neil will talk a lot more about this, but the main elements are that the household occupying the property has at least a legal tenancy or a lease agreement. And if it's a tenancy, there will be some obligations and opportunities to purchase. It isn't always a purchase in a single sum at any point in time. It can be in installments. It can be by building up a savings scheme that provide the cash to buy the properties at some point in the future. And very often it's an option so that the household can rent and doesn't actually have to buy. Always an issue about if there is a valuation in the future, how that valuation is arrived at and how that is agreed and set up. We've talked about issues about who maintains and repairs the properties while it's subject to a tenancy, and whether that right can be sold on to another party, like you would selling a house, you'd sell the options. But critical to all this is that all these schemes require an investor in some shape or form who owns the houses, gets the benefit of the rent and some of the increase in value while it's subject to a tenancy or the tenant doesn't own 100%. So the key issues here are about how is that capital put in and what are the sources of that capital. And we're effectively talking of three main types of arrangements. Rent to own, where the tenant pays an initial deposit and have options to buy the properties in the future. They don't have to, they can continue as tenants and they can walk away, but it's basically a tenancy with an option to purchase. There's rent to own, where the tenant pays an initial deposit, but as well as paying the rent, they contribute to a savings scheme, which is designed to provide the monies to buy the property at a certain point in the future. And there's always an issue about making sure that those monies are protected. And there's a kind of shared ownership, sometimes called shared equity, where the tenant pays an initial deposit and buys shares in the property, buys percentage of the property as they go along. And as they buy those percentages, the amount of rent they pay reduces pro rata. And on top, there's a savings scheme that allows them to buy a bigger percentage in the future until they own 100%. And nearly all the schemes are one of those three schemes. Right, so now I'm going to do a sort of an overview of how the financing works in those three types of schemes. And I've got 15 minutes, and when I do this for clients, we normally have 2 days, so you'll forgive it if you think of it as being very much an overview, but we want to make sure we've got time for the legal bit. If I can just mention some critical elements of this. The first thing is these are schemes for households who have some disposable income that they can use to buy a property over and above the minimum rent. This isn't social housing for those with no, who are only on sustainable incomes. It's more for households who, for some reason or other, have the means to buy, but cannot do so because they haven't got a deposit or no one will lend them a mortgage loan, and that they have to rent, but they have the ability to purchase. And this is financial engineering to make that work. I have to apologize in one sense that all the three examples we've got some spreadsheets showing how the money works. They're all in dollars because that's probably the currency that most people will understand. One critical area of these models is that they do not depend on individuals getting mortgages, personal loans, because one of the major problems of schemes for households in this financial position is it is very difficult for them in Africa to source mortgages. And they could be in the informal sector. They may have variable sources of income. They may have no credit history. So these models are all designed to work without individuals getting mortgages. If they can get mortgages and buy the properties earlier, that's great. But the assumption is that these are for households for whom mortgages are either unattainable or very difficult or very expensive to purchase. And the last point I make before I look at the individual ones is that they all require some form of long-term investment, sometimes called patient capital. And very often that comes from long-term lenders, mainly impact lenders. They sometimes have guarantees for organizations like the World Bank. They may be sponsored by governments, but they do need, and it's critical that there's an identified investor. They can provide commercial return to investors, but certainly in Africa at the moment, there are not private funds that are willing to there are not many private funds willing to invest in this type of project. And one of the trends that we're trying to promote is to encourage private investors to see this as a good commercial opportunity, and in particular to get pension funds, including state pension funds, to see this as a good investment for their funds, because it has some element of inflation protection which meets their liabilities. Right now, this is the first model. It's called the Cooperative Collective Model, basically because you get together a group of households, and there's some good examples of this in Kenya, who want to acquire their own homes, and they form what we call a community benefit company. In some places it will be called a collective or cooperative, where they are all members and they all jointly own the assets and liabilities. Usually working with an agency who is experienced in construction and development and financial management, they will arrange a loan, a short-term loan, sometimes guaranteed by government or World Bank or similar, in order to build or acquire existing homes. They then issue tenancy agreements to their members who occupy their homes, and they pay a set rent for those homes plus a small contribution to a savings scheme, and they will make a deposit usually of about 5% of the value of the home. And that creates an income generating company, which is the community benefit company, which allows them to do a deal, if you want, with a long-term investor like a pension fund, to provide a long-term loan, usually 15 to 20 years, which can pay off the bank loan that they've had so far. And obviously it's net of any deposits. They then rent the property and contribute, and the money above the rent that's needed to pay the interest on the loan is put into a savings scheme, often with the same lender. So very often the firm that's lending the money for the long-term loan is also the manager of the savings scheme. And the savings scheme is designed so that at some point in the 15, 20 years, it will pay off the loan and the property will become fully owned without any debt by the community benefit company, who can then split it into individual ownership if they want to. And very much one of the benefits of this is that someone who's a member of the community benefit company who has one of these leases, if they want to move, they can sell their rights and options to someone else who moves in. So it tends to be more flexible than other schemes, and obviously it gives the members more control. Jen, can we have the next? I've done a very simple example here of what the finances look from the investor's point of view. I hope you'll all look at it when you get the slide pack, because I'm not going to go through every line of this. But effectively, the initial loan is for $1 million. In this case, there's a 10% deposit, so it's 100,000, and there effectively is a loan of about 900,000. And here we've done it as an index-linked loan, but there are lots of different ways of structuring the loan, where they're paying 8% interest, but the amount of interest payable goes up each year by price inflation. So it's a partial inflation-linked loan. And that means that the rents being charged will also go up by inflation. Once they get to the end of the scheme, they've paid off the loan interest, and what they need to do then is pay off the capital. And if there's any money left over, that's distributed to the members. And if you go to the next slide, hopefully, it's not in there, but if we saw the position from the tenant's point, the household's point of view, the interest that is paid to the lender is effectively the rent, and the extra money is going on into a savings scheme managed by the lender, and the savings scheme is a bit like an endowment, is designed to pay off the loan at the end of the period, and effectively they now own the properties. I've already had a time warning, so I don't know, I can go any faster. This is a second type, the private shared equity scheme. This has been done by private developers who are working in that space of affordable housing. And effectively, what they're doing is you have an investor buys 50 homes and gets a volume discount, probably helps financing them, in this case for $18,000 a home, and they sell them into the shared equity scheme for $20,000 each. The prospective households pay a minimum deposit, and then they pay a rent on the unsold equity. So at the beginning, they've only bought, say, 5 or 10% of the home, so they're going to pay 90% of the effective of the rent, and it will again be a rent going up by inflation. And then either at fixed points in the future, which I've said here, maybe end of year 6 and end of year 12, they can buy further installments at 40% each, but it can be, there's lots of different structures. And very often the way it works is that when they buy those installments, the benefit of the increasing value of the property is split between the investor and the household. So sometimes, for example, half of the benefit goes to the investor, half to the household. So that from the investor's point of view, they're getting not only the rental, the index-linked rental return, they're getting a benefit from the inflation increase in the properties. And if we go to the next slide, and you see here what it looks like from the investor's point of view, the cash flows, that initially they sell, in this case, 20%, and then they sell another 40% in year 6, 40% in year 12. But there are schemes where they can buy in much smaller installments each year, a much smaller amount. And from the investor's point of view, they get the initial investment plus the rent plus the inflation in the from the original cost. And we've computed here that actually the yield is nearly 30%. But in practice, there will be other costs like legal costs and so on. So this is a very oversimplified model that gives you an idea about how it works. And then if we go on, and this is, and if you look at it from the homeowner's point of view, where they're buying 20% at the start and buying 40% at the end of year 6 and the other 40% at the end of year 12, and you look at the cash payments over that time and bring it back to a present value compared to the original cost of the home, you can see that there's a that the effective cost to them in cash terms is $7,000, but because of inflation and what the cost of that money would be to them, it's probably not that different from actually having bought the property outright. And we know these schemes work because there are lots of private developers who sell to households in installments in a very similar way, but actually without the legal and financial wrap. They just basically do it from their own working capital as a way of selling property. And I remember going to a number of schemes in Abuja where this model was basically used as an informal model by developers selling their properties. Jen? And this is a slightly more formal one. Same principle, but here, investor buys the houses, rents them to the households. It says their deposit of 5% of value. It says 500K each, which is a bit lot. It actually should be $500 each as being the deposit. And then this is a very simple where they basically rent the property, and then when they want to buy it, it's valued, and then they pay the value price less 1% for each year of occupation. There's different ones. Some it's more or less depending on the rent levels, but effectively it's a sharing of the increase in value of the properties between the household and the investor. And the households can use saving schemes. They might be able to get a loan. They might work with their family to raise the money to purchase. They just might earn more income in later years, but it's very much a flexible scheme, which basically gives the tenant, the household or tenants, the option to purchase at their point in choosing, but still gives a market return to the investor. And again, it's a rent which will go up by inflation each year. And for those of you who have got lots of time on their hands, there is a spreadsheet which shows basically how this works. And one of the most interesting things about it, it doesn't actually matter when the household purchase, because if they purchase in year 5 or they purchase in year 20, the rate of return to the investor is no different, providing basically the value of rents and the value of homes go up with the rate of inflation. And the reason we've done them this way, we've looked at commercial schemes because in Africa, schemes are only going to be replicable if they're commercially viable for investors. If you can get the only subsidies that are usually available is free land, and that obviously reduces the level of rent that's required, the amount of loan that's required, and therefore you can move down to lower income households. But one has to remember that this is home purchase, and it needs to be households who feel they have a stake in the property from having used some of their own funds or their own savings, and have the capability of managing a property themselves and of paying a rent and servicing a loan. So this is not social housing. This is a way of bringing lower income households into the home ownership stratosphere, whatever you want to call it. Right, I think I'm getting lots of warnings about stopping. I've noticed the number of participants has dramatically increased since I've been talking. I think that's flattery. Thanks, Jim.
Thanks very much. I'll take over now. I'm going to be looking at buy to rent through the eyes of a lawyer. First of all, I'm going to look at a fundamental legal basic about land ownership, and then I'll be looking at various legal topics that need to be covered when devising these products in particular jurisdictions. So if I could, my first slide, Jen. So from a lawyer's point of view, the fundamental question about land is who owns it and what interest do they own. And in most jurisdictions, very broadly speaking, and the terminology is different, there are three different types of ownership of land. Ultimate ownership is freehold. That means the person owns it forever. They can do with it what they want. They can occupy it themselves or let other people occupy it. They can usually build what they want, subject to planning, and it's up to them whether they keep the property in repair or not. Second class of title is leasehold, which is ownership for a defined period. It can be 125 or 999 years. It could be a long time. And during that time, the freeholder's owner is temporarily displaced in favour of the leaseholder. So the leaseholder has a very decent ownership of the land. Often the lease will impose obligations on the leaseholder, such as to pay rent or to keep the property in repair. And if those obligations are breached, then the freeholder can usually take the property back. And then finally, you have tenancies, usually weekly or monthly. Usually in reality, they run on week to week. So the person might occupy the property for a long time, but they don't have a long-term interest in that property. So it's important to understand those three different types of ownership. Broadly speaking, unless there's contradictory laws, a freeholder and a leaseholder or a tenancy are free to agree what they want and what they want to put in their lease or tenancy. Having said that, in most jurisdictions, there are restrictions on what you can put in leases or tenancies because there's a layer of law added on top of what is agreed between the parties. So where leaseholds are concerned, there's often protections in the law to stop the leaseholds being brought to an end for minor infractions. In a number of jurisdictions, there's limited rights for the leaseholder to actually forcibly acquire the freehold from the freeholder. In relation to tenancies, there are often provisions that give the tenant a degree of security of tenure. So whilst the parties may have agreed that it only takes a week's notice, there might be a statutory level on top of that, which gives added protection. And then finally, there are quite often issues on tenancies in relation to repair. UK is an example of that, where in a tenancy, the tenant is not allowed to be required to repair the structure. That is deemed by Parliament to be something that the freeholder ought to be doing. So the concept of rent to own is sort of bending these three ownerships together in the sense that often someone is there as a tenancy, which means they have logically, from a legal point of view, no long-term interest in the property, but the intention is they're going to buy it. So they need to have the protection of someone who wants to buy that property and is clearly going to have a very long-term interest going forward. So quite often the legislation or the legal issues don't neatly fit into rent to own. So it's important that when you're devising a scheme, you look carefully at the legal framework of a particular jurisdiction to see that how that applies to tenancies, how that applies to leaseholds, and how that applies to the structure you're setting out. So next slide, please. So I'm going to be looking at two particular types of rent to own structures and the legal implications of those. The first is the tenancy-based one, where the person is given a relatively short-term tenancy, weekly or monthly, but that's coupled with a long-term option to buy the property. And the second one is a lease, where the person has a long-term lease, where they pay part capital and part rental payment, and they have the ability to pay further capital payments going forward. So I'm going to look at those two separate types separately because they have different legal considerations. So next slide. So kicking off with the legal issues relating to the tenancy model. So again, this is where a short-term tenancy is granted and it's coupled with an option to purchase. Looking at the UK and USA experience actually gives quite a good insight as to some of the issues that arise with this. In the UK model, these products are usually provided where the rent is subsidised, and that gives the tenant the ability and space to save money to buy the capital value of the home. In the USA model, in fact, it's the opposite, whereas tenants are often required to pay more than the market rent, and the surplus is effectively taken by the landlord as a saving, effectively a forced saving product. The issue with this is one very much of security for the tenant. If in the UK model, the landlord doesn't honour the option or disappears, runs off, in the UK model, it doesn't really matter that much to the tenant. The tenant has had lower than market rent anyway for that period. Savings that it will have saved in its own product, and therefore the landlord disappearing is not a huge issue. In the USA model, that is a big issue because the tenant has been paying over the odds in order to build up a capital sum with the landlord. And in my experience, the African models are more akin to the USA model without subsidy. So it's important in these that there is some protection for the tenant in terms of the savings that they've been building up, be that escrow accounts or bank bonds or some sort of secure saving product, so that if the landlord disappears, doesn't honour the option, the tenant isn't left out of pocket. Next issue on these is the length of tenancy, effectively how long is short. Usually the intention is not that the tenant will be there forever. Usually there is a requirement that at some stage they either decide to purchase the property or they move out. But there's no legal requirement on that. In theory, the tenancy could go on indefinitely before the tenant decides to take their option forward. But broadly speaking, usually that would involve very patient capital, and capital isn't usually that patient. So you usually have a period of time after which the tenant has to make that decision. And again, what happens at that point depends on whether or not you have a UK type model where there's subsidy, in which case the tenant hasn't really lost out. It could be expected to leave the property and someone new come along. In the USA model, if that happens and the tenant decides not to purchase the property, it will have been saving up capital value, and that will have gone to the landlord. So there would be an issue then about whether or not there would be some provision saying that some of their capital would be paid back to them if they leave. Next issue, which I've touched upon, is repair. During the tenancy phase, the tenant realistically only has a relatively short-term interest in the property. So there's a question about whether or not, if during that time they're unlucky enough that a major repair is needed, whether they should foot that themselves or whether the freeholder should foot that as the person who at that stage has the capital value of the property. As I say, in some jurisdictions that's dictated by legislation, which specifically says tenants aren't permitted to be forced to contribute towards the cost of major structural repair. Fourth issue, rent setting. Tenancy will be going on from year to year. Tenant needs to know what rent it's going to be paying each year. And there are effectively three possible options during this phase. One is to have a fixed rent, which doesn't ever go up. That's easy and certainly provides certainty, but in reality, that's not very likely. That would mean that inflationary pressures would erode the rent as time goes on, and therefore real rents would be falling. So that's relatively rare. Inflationary index is probably the most common, where simply rent goes up every year by inflation, easy to operate, gives both parties certainty. A third option, though, is to have annual open market assessments of rent. That might be the fairest, since it means that you pay market rent at the time, but it brings with it effectively transaction costs, in the sense that that means you have to pay for evaluation every year, and there isn't the degree of certainty to the tenant as to what they'll be paying. And then similar issues arise with the last bullet point, which is as and when the tenant decides to exercise their option to purchase, what value do they pay? And that can either be fixed at the outset with an inflationary figure going up each year. So if they buy at the end of 5 years, 5 years worth of inflation are added to a figure that was agreed right at the outset, or quite commonly, you simply have a market valuation at the point that the tenant wishes to exercise their option. So those are the sorts of considerations that I think are the main considerations that come when you're drafting a rent-to-buy product where you're basing on the tenancy model. And then if I go to the next slide, Jen, that then takes me to these sorts of issues that apply in relation to the leasehold model. So going back to the basics again, what happens here is a leaseholder will buy, say, a 125-year lease. They'll pay 20% of the capital value at the outset, and at the beginning they'll be paying 80% of the market rent. And as time goes by, they have the right to what's known as staircase, which is pay further portions of the capital value, and each time they pay for a further portion of the capital value, the portion in which they pay rent declines. So looking at some of the issues that come up on these particular models, repair is also an issue. There's more logic here for the tenant to be responsible for all of the repairs in the sense that they do have a long-term interest in the property. In the UK, that has actually caused some bad press and bad feeling amongst tenants who feel that if they only own 20% of the capital value, why should they be paying 100% of the cost of a major repair? I mean, I would argue that's fairly straightforward in the sense that the reason is because they're occupying 100% of the property, they're getting 100% of the kind of occupation benefit of that property. But that is an issue that gets talked about, and that is an issue that you quite often see unfavourable press reports in the UK about this model. Rent setting is no different from the tenancy model. You need to work out what rent is going to be paid each year, and that can be based either on an inflationary index or on a revaluation to a market rent each time. Staircasing is an issue. So as I say, at different stages, the tenant is given the right to purchase a further portion of the capital value. The normal way of doing that is when they want to do that, you have a valuation of the property, and that sets the market value of 100%, and then the tenant gets to pay, say, 10% of that to buy a 10% share. The difficulty with that is that is a relatively costly procedure in the sense that every time their staircase, a full market value has to be obtained, and that can add, as I say, transaction costs and discourage what we call micro staircasing, so staircasing at very small amounts. That has been addressed in some models where you effectively use a old valuation, but you apply inflationary index to it for each year, and that makes the process cheaper and therefore quicker. And in fact, that's being introduced in the UK at the moment. The UK government is promoting that as an option, and there are a number of people operating these schemes that are looking for effectively apps on the phone where someone can actually just purchase via the phone and their bank an extra portion to make the transaction cost of doing so much cheaper. And then the final legal issue on the long-term lease option is what happens in default. In most jurisdictions, in the event of default, the landlord can bring the lease to an end. And in a number of jurisdictions, that is particularly unfavourable for the tenant, because that means the tenant ends up having no compensation whatsoever. They have breached the terms of their lease, therefore the landlord gets to bring it to an end. But in these situations, the tenant has already paid for a degree of capital value, and that can sometimes be seen as unfair. A number of jurisdictions provide protection for the leaseholder in that position. So it's important when devising these schemes, you look at the law in a particular jurisdiction. And then final slide, just some observations from me. In my paper, I've always looked at the option to buy or the option to staircase as being an optional thing for the tenant or the leaseholder. There are a number of models where actually it's not optional. They are expected and required to exercise their option after 5 years or to staircase by certain percentages each year. It's just that there's not one right answer, but that's something to look at when you're devising a scheme. The impact of inflation, a number of situations where I said you would apply an inflationary index. Certainly in my experience, that's always been fine. That's never been an issue. But recently with inflation going up so so unexpectedly high, that is actually causing a number of problems to a number of landlords where tenants simply aren't able to afford their rent. Last 3 points, scams, particularly in the tenancy model where you are paying money to the landlord as an advanced down payment on the purchase. There is an opportunity for landlord scams, and it's going to be important to make sure that there are protections in place. Keep it simple. These are relatively complex from a land ownership and contractual point of view, relatively complex products, and it is very important that the tenants and the leaseholders understand what their rights are and understand what their obligations are. And certainly, again, in the UK, there have been a number of instances where people clearly haven't understood what buying a shared ownership lease means, what, as I say, being responsible for 100% of the repairs, but only 25% of the property. It's really important that that's explained to people who are buying these. And then finally, a comment that Derek's already made, these products are not for people who cannot afford to buy their home. They're for people who can afford to buy their home, but for some reason can't afford to buy them now. And that's it. I'd wrap up there.
Thanks very much, Neil and Derek, and apologies for making you fold an hour-long subject and content into 15 minutes. Well done. We only have about 10 minutes for questions, and I wanted to relay one question that was from the chat that Carlos raised from the KMRC, and that relates to how rent-to-own can drive mortgage uptake. So it's been acknowledged that this model, the schemes are there in situations where mortgages may not be accessible, but what role would these schemes perhaps have in stimulating mortgage uptake? And I think perhaps that's a question for Derek. Neil, if you don't mind, I just wanted to pose one question to you, perhaps by way of wrap up. In the context of the African continent, I think a lot of the challenges in many of the countries is around the existing legal framework and whether the legislation is in place in terms of tenure and tenure security to enable this type of scheme. So I guess my question would be, in terms of legislation and the rights and procedures that are encased in law, what would be the preconditions in a country for this system to be working effectively? So if Botswana is concerned about taking on this scheme, what are the first questions they need to ask themselves about the existing legal framework to make sure that it would be successful? I'm going to give you a challenge of perhaps 4 minutes each on those. Perhaps Derek, if you could jump in and give it a shot.
Yeah, I think the key, I think Neil's raised most of the main preconditions legally in terms of valuation and security of funds on the tenure. But I think from the financial point of view, I think there's two really critical things. One, as we've mentioned before, is sources of patient capital. There in Africa, this isn't seen as a major investment opportunity in the way that perhaps student accommodation and others have become opportunities. And so rent to own has relied on impact funds, guarantee schemes, government intervention, and so on. And if it's going to fulfill its promise, it needs to be created as an investment opportunity. And in other continents, that's initially been done by offering tax breaks to investors, things like that, in order to show the advantage of this investment. And then over time, those tax breaks have disappeared and it's become that kind of investment. And I think the other big challenge is there's very little index-linked returns, but actually in countries where you do sometimes have high levels of inflation, educating both the public and investors in the idea of inflation-linked returns, so that their returns, in a sense, are linked to the rents that people pay, and that makes it more affordable to start at lower rental elements for these type of households. I think it is also another critical element, because that it's so. What I'd love to see is a start to a sort of like a capital market which offers index-linked bonds based on the returns for these kind of properties, and encouragement to the providers of capital to see this as a good investment, and for them to see how successful it's been in other continents as being both an investment and an opportunity for low-income households.
Cool. And then turning to the question to me in terms of legislation, I think the fundamental importance is to have a relatively straightforward lease structure and tenancy structure, a confidence that that will be enforced, so confidence that the court system is there, that if someone breaches it, it will be enforced. And also, and again, this happened in the UK at the beginning of the process, sometimes the legislation cut across the model in the sense that, I say, there are some jurisdictions have rights for a leaseholder to buy the freehold. You've got to make sure that that doesn't cut across the right to staircase, because you need the two models to work together. So it's not particularly fiddly, the law. It is just basic property law. It's making sure it's certain and it's enforceable.
Thanks, Neil. That's helpful, and Derek as well. Perhaps in the last couple of minutes, Andrew, is there anything you wanted to add?
I don't think I've got anything to add. Derek's covered most of what I was going to talk about, to be honest. But as Neil says, I think the key to a functioning system is the regulatory and legal framework that exists in the country where it's operating, as a form of sort of mid-market supply and investment model.
That's great. There was one follow-up question I see from Carlos. Let's see. Carlos, are you able to speak to that briefly? Jen, I don't know if we have it open for participants to.
Yeah, no, he's on now. He was muted.
Okay, there we go. Go ahead, Carlos.
Yes. My concern was on how maybe we can marry a rent to own. How can rent to own a model drive mortgage uptake?
I mean, I think that it does it in the sense that I think I'd say two things which are slightly conflicting. It does it in the sense that it gets people onto the property ladder in steps, which means that their mortgages can be stepped, which you have more people who can afford to buy a bit of a house, and therefore the mortgage is a bit smaller, possibly. That's one point. Again, I go back to the UK because that's my experience. That's where I practice law. Mortgagees have actually been relatively reticent about shared ownership in the past. Although we've got a very well-developed mortgage market, there are a number of mortgagees who won't lend on shared ownership properties on the basis that, by definition, the people who are looking at shared ownership property are on the margin of whether they can afford it. And so therefore that is an issue. In the UK, that has been dealt with by shared ownership leases. Effectively, if a leaseholder stroke borrower defaults on their mortgage, the lender is protected by taking a chunk of the share of the freeholder. So effectively, the freeholder provides protection, and that has worked very well in the UK, but that involves the freeholder being willing to take that risk.
Yeah, can I add something to that? Because when we've done schemes in Africa, we found it virtually impossible to create something which banks, the financial institutions are willing to provide mortgages on. And for these lower income households, they wanted such a large deposit and such a high interest rate that it's not been, that even if they were willing to offer the mortgages, it wouldn't have been feasible for most of those households. So the models that we've developed assume that mortgages aren't available. And they're still perfectly feasible because it's volume capital that's being used that has a much lower rate. By giving the person with the options or the possibility of owning the property discretion about when they buy it and how they buy it, they only are put in that position when they have the ability to afford it, as opposed to schemes where you actually have to buy it year 5 or you lose it, which is quite difficult because you're trying to imagine what your financial position will be in 5 years' time. So I think there's a number of reasons that until the housing market develops and the financial markets develop, I actually think mortgages for these households are actually slightly dangerous in terms of how it might, the likelihood they might default and they might lose their home, rather than be a tenant at any purchase when their income is sufficient or their savings are sufficient. So, and I think, I mean, the World Bank won't like me saying it, but mortgages aren't always the answer to these kind of problems.
That's great. Thank you, Derek. I think you're quite right. And it's a little bit of refreshing to have a conversation that doesn't center on mortgages. I'm afraid we've come to the end of our time, but thankfully we have one more session in the series, which will be our 4th session, which will be on the 21st of September. And this will allow us to unpack a little bit more some of these examples in the African context, which I think will be useful as a carry-on to this conversation today. So I would encourage you to join us, please, on the 21st. Perhaps, Thandiwe, you could share the link for signing up to that session in the chat. That would be helpful if people could, interested if they can do that before they depart. So thank you very much to Altair and to Neil and Derek and Andrew and to Jen and Thandiwe, and to all of our participants and this conversation. And thank you for your time. And we look forward to seeing you on the 21st and continuing this conversation. Thanks very much.
On behalf of the speakers, thank you, Alison.